Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, let introduce myself. My name is Alpino Firnando. This time, I will explain about 5 types of account. In accounting, an account is a place to record changes in the value of an element in a financial report. Every transaction that occurs will affect one or more accounts. To understand more, let's learn what an account is, as well as the 5 types of accounts that are often used in accounting. 1. What is an account in accounting? Accounts are records or bookkeeping used to record changes in the financial elements of a company. Each account records transactions related to a specific element, such as assets, liabilities, income, or expenses. In accounting, accounts are divided into categories, each of which has its own bookkeeping rules. 2. 5 types of accounts in accounting. There are 5 main types of accounts used in accounting, namely 1. Asset account. Assets. An asset is anything owned by a company that has economic value and can be used to generate income in the future. Asset accounts can be divided into 2 categories. Current assets. Assets that can be used or sold within 1 year, such as cash, receivables, and inventory. Non-current assets. Assets that have a lifespan of more than 1 year, such as land, buildings, machinery, and vehicles. Example of an asset account. Cash accounts, receivable supply, equipment. Nature of asset accounts. Increases on the debit side, debit increases assets. Decreased on the credit side, credit decreases assets. 2. Liability accounts. Liabilities are debts that must be paid by the company to other parties, both in the short and long term. Liabilities are divided into 2 categories. Short-term liabilities, current liabilities, debts that must be paid in less than 1 year, such as business debts and tax debts. Long-term liabilities, non-current liabilities, debt whose repayment takes more than 1 year, such as long-term bank debt and bonds. Example of a liability account. Accounts payable, bank debt, tax debt. Nature of liability accounts. Increases on the credit side, credit increases liability. Decreases on the debit side, debit decreases liability. 3. Equity account. Equity. Equity is the owner's rights or claims to company assets after deducting liabilities. Equity also reflects the owner's contribution and profits retained within the company. Example of an equity account. Paid-up capital, retained earning owner's capital. Nature of equity accounts. Increase on the credit side, credit increases equity. Decreases on the debit side, debit decreases equity. 4. Income account. Revenue. Revenue reflects the economic inflows received by a company from its operational activities, such as the sale of goods or services. Income can be fixed, for example, rental income, or variable, income from product sales. Example of a revenue account. Sales revenue, rental income, interest income. Nature of revenue accounts. Increase on the credit side, credit increases revenue. Decreases on the debit side, debit decreases revenue. 5. Cost account. Expense. Costs are expenses incurred to generate income. Costs can be operational costs, such as salaries, rent, and utilities, or costs related to the production of goods or services. Example of cost account. Salary costs, rental costs, utility fees, raw material costs. Nature of expense accounts. Increases on the debit side, debit increases expense. Decreased on the credit side, credit decreases expense. 3. How to record an account. Every transaction recorded in accounting will affect 2 or more accounts. This recording process is known as double entry, which means that each transaction will affect 2 sides of the accounting equation. The debit and credit sides must always be balanced. Example of recording. For example, a company sells goods worth IDR 5 million in cash. 1. Assets. 1. Assets. Cash increased by IDR 5 million. 2. Income increases by IDR 5 million. Transaction journal. Debit. Cash. Assets. IDR 5 million. Credit. Income. IDR 5 million. With this recording, balance is maintained because the amounts on the debit and credit sides are always the same. For conclusion, understanding the types of accounts in accounting is very important because each account records changes in a company's financial elements. The 5 main types of accounts: assets, liabilities, equity, revenue, and expenses, are the basis for preparing financial statements. Knowing the nature of each account, debit or credit, is also important to ensure that transactions are recorded correctly and the accounting equation always balances. Thanks for watching. Raising hands.